Hello and welcome to this session brought to you by the Academy of Practical Accounts in conjunction with your institution. In this session, we'll look at the recording of a laptop purchased for the business. In traditional accounting, a laptop is a fixed asset which is recorded not as an expense but as a fixed asset, and the value lost is written off using depreciation, which is disallowed for tax purposes, and instead written off using what we call tax allowances. However, for cash accounting and in the simplified format, because this laptop is going to be used for 2 years, it can be recorded as an expense, as it was discussed in the previous session. The difference between cash accounting and traditional accounting. So this laptop can be written off in the year of purchase as an expense. So we're going to look at the source document. We'll look at the recording from the recording process, trace the double entry, and identify the affected accounts. Now, below here is our source document. This should be a receipt. Apparently, it was paid by credit card. So we proceed to record this on our mobile device. Now we're going to use the horizontal alignment, which displays a bit more. All right, so we rotate the device. There we are. Okay, now let's drag this to the left. Let's drag this to the left. There. And we have more space for our mobile device. Now let's go back to, let's go home. Let's go home. Now we'll look at miscellaneous here. We've got a form for recording all allowable expenses, and if you recall, that is form number 2, because we're using the cash accounting method, not the traditional accounting. Traditional accounting, it would be a fixed asset, but it's going to be an expense because it's going to be used for only 2 years. Many laptops don't last longer than that. Okay, all allowable expenses. We click the form. There we are. Now, this form, remember, with the new requirements of the Revenue and Customs, we are able, or we are allowed, to record all expenses on one expense account, and that is cash number 25. And the differentiation we can create is the narration, and we say we remove the whole of this, and we're going to call this a laptop. A laptop. That's it. Now, apparently, forms number 1 up to probably number 5 generate document numbers basing on the last recorded document number. So this one has generated number 10. Assuming there was no document number, we would be copying the number from there and recording on the form. And the aim of this is to match this transaction in the accounting records with this source document. Anybody who wants to verify whether it's an auditor, of course, for a small business, we don't expect auditors. We're looking at tax officials. Then they can trace the transaction with the source document. Now, how was this paid? It was paid by credit card. This one, there is no option, so we'll only select the credit card account below here. Now we've got several credit card accounts there. CRE. So we're looking at the first credit card account, and then the amount is 804. 804. And that's about it. The rest is done. So we click save and close. And that's it. Now the next task is to trace the double entry, and for that one we shall need to change the orientation in order to see more transactions. So we scroll down, periodic tasks and reports. We scroll down, we get to report P5, which is the general ledger, And for month 1, there are no transactions. We're looking at month 12. So we scroll down, we get down to month 12, and these are our transactions. Now we're looking for a transaction with document number 10. Document number 10 with an amount of 804. Now on this document, we didn't isolate the VAT amount simply because the business is not VAT registered. It's a small business. So we record the whole 804. So let's pinch our screen to see what we're looking for, document number 10 and transaction number 10. So on the all expenses account, we can see the 10 there. Yes, we can see the 10, transaction number 10, document number 10, and that is the 804. That is where the value went. Now, where does that value come from? Remember, in accounting, one account receives a value and another account surrenders the value. There's a transfer of value, what we call double entry. So the account receiving the value gets it in form of a positive figure that is indicated by black. And the account surrendering the value has a negative entry. So we are looking at, okay, now the final task is to identify the reports affected on a cumulative basis. Now, this was an expense, really, which affects directly account G or report G3, and that money came from a credit card. So the other report that should be appearing here should be the credit card. Now let's trace that on the device quickly. Credit card report. Let's go to our mini reports checklist. Mini reports checklist. And we scroll down, credit card, yes, credit card. That is report S3. Let's have a look at report S3. So that is the only new report. Otherwise, the list generated so far remains as it is. So that is the 804 paid out by credit card. And when you get time, please look at all the other reports. But this particular transaction has only made an extra effect on the credit card report and the expenses account. That brings us to the end of this session. In case you have any questions, please send us an email at admin@practicalaccounts.com or find us on Skype. We are Accounts Coaching. Thank you.